I tell providers that if you don't have patient financing in your practice, that's quality, that's designed to, create affordability for these large cases, you're going to miss about 60 to 65% of the market.
We've been misled to believe that dentistry, more specifically the dental business, has to be complicated. Dentistry can be simple, and dentistry should be simple. All right, good afternoon, good day, wherever you're at. Welcome to another episode of the Dentistry Made Simple podcast. I'm your amazing host, T-Bone, and this week instead of Meredith, we have Dave Roehr from Proceed Finance on this week, and we're going to be talking about the realities of third-party financing, why you've got to get on board, and what you can do to improve your practice and better utilize all services, but hopefully their service. So, Dave, how are you doing?
Hey, I'm doing great. I appreciate the opportunity to be on your podcast, and hopefully your audience and listeners will get some value out of this.
Yeah, well, I'll make sure of that. Okay, we'll both make sure of that. So, Dave, let's give a real quick, so to kind of frame everything for everybody. Look, we're going to obviously, Dave is going to talk a little bit about specific things with Proceed, but what I love about Dave is that he's going to give us an overall market view to help you understand third-party financing as a whole in general. And obviously, I'll come in from a implementation side and a reality side. And really, we want to make this super helpful for your practices. And let me start with this. We have no choice, but I need you to make third-party financing important to you, because what we know with working with almost 60 practices at this point is the offices that connect with third-party financing and make it important, we see their revenue skyrocket. And more importantly, we see them doing the type of dentistry that they want to do. Dave, and so Dave's company, or Dave products like Dave's company, Proceed Finance. Dave, let's start with, not all third-party finance companies are created equal, okay? And talk to us a little bit about what should somebody be looking for when they're choosing a third-party finance partner?
Great question. Well, I started this company about 7 years ago, and it was really a result of me doing a consulting project. I was kind of retired, got bored, had to do something. So I was doing a consulting project for a name everybody will recognize, Clear Choice Dental Implant Centers. Mm-hmm. And they had just had some this was sort of after the financial crisis of early, about 10 years ago, in the aftermath of that, where lenders were dropping patient financing in dental. And, everybody was scared of the risk. A lot of banks were kind of doing it in and out, but they had just lost two of their major patient financing lenders and brought me in to figure out, a short-term solution and then really a long-term solution, because you just can't afford that business interruption when patient financing is a material part of your revenue stream. So,
Dave, I want to interrupt you there for a second. I apologize. To kind of give perspective, I don't know what you're allowed to share or not share, but how important is third-party financing to a company like Clear Choice?
Extremely. It's a material part of their business model. I mean,
50% of their patients probably need financing?
Yeah, at least. I think, their metrics probably at least 40, maybe some months up to 50% of their revenue comes from patient financing. Yeah. So, and the rest comes from, the sources that the patient has. You have some people that can pay cash. You have some people you can put it on plastic or a credit card, or have, resources that they can tap into to pay for the procedures. But patient financing is just critical for them. And it will be for anybody doing, high-end cosmetic dentistry.
Yeah.
I mean, I'll give you some reality checks and this is not news, but I think we're up to now almost 2/3 of the country live paycheck to paycheck, and statistics that's put out monthly, and it's something like about the same percentage of people in this country don't have enough savings to pay for $1,000 unexpected expense. Yep. So think about that. These people want to pay.
And a tooth is an unexpected expense for a lot of people.
Exactly. And these people want to pay you. They just can't pay you now. They need help. And if you don't have quality patient financing available to those patients, they're going to go to someone else that does, because, they just don't have the financial resources or cash or whatever to pay you up front, especially when you get into, elective, uninsured, procedures where, most of implantology, cosmetic dentistry is in general not insured. Medical or dental insurance doesn't cover it. So if you want to do this work, you're going to have to, you have quality financing available to people, and you're going to help your patients navigate through the whole financing and journey, and understand how it all works, because the practices that get good at this do very, very well. And, I tell providers that if you don't have patient financing in your practice that's quality, that's designed to, create affordability for these large cases, you're going to miss about 60 to 65% of the market.
Yeah.
That's
And I want to expand on a couple of points there for the listeners. Is having looked at P&Ls and revenue statements for lots of offices now, when we start with them, what I'm seeing is the average third-party financing as a percentage of revenue is less than 5%.
Yep.
Okay, so that tells me you're doing lots of insurance-based dentistry. Where we try to get people to at the beginning is baseline is I want to get you to 15%. Okay, that means you're doing lots of general dentistry at one time. And then I want to get people like where I was at when we're at our absolute best in my practice, 30 to 35% of my total practice revenue comes from third-party financing. And that means we're doing bigger cases. Now, we're going to talk a lot about implant dentistry, but bigger cases to me is anything. And by the way, what would you define as a bigger case in dentistry?
Well, great question. Our loan ranges today, we start at $2,500 and we go all the way up to $75,000 is our range of lending. And that's all unsecured, non-recourse lending to the provider. So, our average ticket today, and we focus a lot on implantology, is just about $23,000 is our average loan. Now that's a large ticket, but we also, play, single implants that might cost $5,000. We still produce a very low payment. And if you're into cosmetic dentistry like veneers, it works very well. Anything that's a ticket over $2,500 recurring is usually I consider a large ticket, because that's when insurance stops paying and the patient has to cover the out of pocket, and that's when they need help. So I would say if you have a procedure over $2,500, patient financing is going to become very relevant. And as your treatment plans exceed that and go up from there, it's critical that you have it, because you're going to miss the market, and patients. There was a survey done by Becker's, and it was really interesting about the behavior of patients, and the question really was, how important is your provider's ability to offer quality patient financing in your decision to go to a practice. And 95+% said that they expect it's a need, not a want, expect their provider to have quality financing available for large case procedures. They expect it, because if you don't have it, they're going to find someone else. And then even further is if that same group said, if we have a great experience with a provider that offered financing that was attractive, that was friendly, that was, with a good lender, we would refer people to that practice and spread the word about the experience that we had. So, think about if you don't have quality financing, first of all, if there's a lot of out of pocket on the patient's behalf, they expect you to have it. So if you don't have it, they're going to go somewhere else. And then if you provide a quality experience, you're going to get referrals. So, it's just the impact and importance of it just becomes that much more and more important to realize what you're doing. So you asked the question about, okay, what what's important in patient financing. And especially with larger tickets, what I did when I started our company is when I did that consulting project for Clear Choice, what I learned was there really wasn't a product built specifically for large case dentistry.
Yeah.
What was out in the marketplace was you had products that banks, maybe a credit union or whoever had, and it was an unsecured consumer finance loan. And they basically said, here's what we have. You make it work in your business model. Okay. We're not going to modify.
And what I found from experience is a lot of those companies they were playing in that $500 to maybe $10,000 range. Yep. They would claim they would extend credit up to $20,000, $30,000, but the number of people that got approved for that was so far and few between that they were really
it wasn't doing you any good. Right. And that's another thing that I'll talk about that's important. So what I decided to do, I said, look, there's nobody built a product specifically to service this market, with uninsured elective high-end dentistry, that's not covered by insurance. So let's build something for the industry. And so how I figured out what to build was I interviewed literally almost 100 people, treatment coordinators, doctors, practice owners, the executives and DSOs, and really asked the question, if I built you a patient financing product, what's your perfect world? Okay.
Yeah. You reverse engineered it.
Exactly. And then build it from the ground up, not, a top down approach where, hey, here's what I got. You got to make it work. I'm going to make something work for you based on what you need and what works for you. So there were really 8 things that came out of that. And they're about half of them are as you would expect, but here's what we focused on. So here's what they told me is number one, they want fast funding. Okay. So that wasn't the most important one, but they want to be paid up front before they start their procedures and they want their money quickly. That obviously is kind of a given. It had to be fast and easy. So the platform and technology had to be something that worked. It was fast, easy to use, and they would not have paperwork or callbacks or, hey, I can't make a decision. And they want something that's simple to use because they want to whoever's dealing with the money part of their practice. It has to be something that's easy and fast to use. So, okay, that's one, but they also wanted an instant decision platform. So whatever credit decisions you're going to make on people, it has to be instant because we don't want people leaving the practice not knowing if they're approved or qualified or how much money they have. Because if we have to call them back and the decision is made later and bring them back in, the slippage rate or the people, the ability to get them back in just diminishes and that hurts their business because X% of the people that leave without knowing will not come back. So it has to be instant decision. Of course, no recourse to the provider. So if the credit risk falls on me, the lender, and if the patient doesn't pay, that's not going to come back to the provider. So there's no recourse. So that was a must. Of course, they wanted VIP customer service. So what happens is if there's drama or if there's an issue and the patient's in the practice, they're trying to, go through the treatment plan, trying to figure out the money. And if something doesn't work or something happened or whatever, they want to be able to pick up the phone, have a rep available immediately to help them solve the problem and fix it. So you had to back it up with, a call center for the providers. And we at Proceed, we pride ourselves. We answer our phone calls that come in 12 seconds or less.
You actually answer the phone? That's amazing.
Yeah. Well, 12 seconds or less with trained, experienced reps that know what the problems are and can assist either the patient or the provider to, make everything move forward if there's an issue. Okay. So they wanted that. They wanted trustworthy financing partner. So what that means is they wanted the lenders to treat their patients just like they treat their patients. In other words, no abusive practices, no hidden surprises, no gimmicks, no gotchas. They wanted a very honest product that is easily understood, and there's no tricks or gimmicks. And the reason for that is, think about it. If you put your patient in a loan or a financing product that, turns out to be higher interest if they, do this or that, or retro interest, or some gimmick that's not clear, and it's, like a gotcha, is that comes back to the doctor and the practice. If that's your brand, why did you put me in that loan? I didn't know this. Do you know how they're treating me? You don't want to listen to that, and you don't want that to happen to your patient. So you have to trust your lender and patient financing solution that they're going to treat your patients just like you want them treated, with dignity, with fairness, with, everything to do. And if they get into financial trouble and they can't make their loan payments, well, we have forbearance programs, where we understand there's a problem. We're going to work with you and take care, try to help you get back on track. So that's the kind of quality lender that you want to work. You don't want somebody coming back into your practice saying, they put me in this financing product that it's ruining my life. Because, that's going to impact.
They tricked me into it. Right.
Yes. Okay. So that's it. Now, the last two are probably most important. They wanted quality approvals. So you just mentioned that a lender can say they give a lot of approvals, but if it's not for amount of credit that puts people in play to cover the treatment plan, it doesn't do any good. So
yeah, I don't need people getting approved for $300.
No offense. $3,000 or $1,000 for a full arch procedure. That procedure is going nowhere. So you need quality approvals where, when they approve, they give enough credit to put people in play for access and completion of a treatment plan that's expensive. Okay. So what we do is, when we approve, just to give you an example, our average approval when we approve is over $44,000. And like I told you, our average funded loan is about $23,000. So that's a quality approval. That will put people in play for a full arch, or in a lot of cases, a full mouth reconstruction. And the credit and financing is available so they can go forward. And that's what we pride ourselves in. So that's a big difference between us and other lenders, is just the line assignments and the credit approvals and the quality of our approvals put people in play so you can do life-changing procedures, and advance your practice into these high-end procedures. So that was important. And then finally, and they want that frequently, of course, right? So, we can't give it all the time. And we're taking credit risk, and, I have to stay in business. So, but when we approve, and I have a secondary lender that takes the challenging credit, but we'll give a quality offer if we're a first look lender, meaning you come to us first for credit, or the application comes to us before someone else has a chance to look at it and reject it. But on a first look lender, we'll give you an approval rate of 55-60% with a quality offer. So, that's significant, and that's what people expect of us, and that's what you should expect of your patient financing lenders. But the final one is affordability. I mean, that was the number one complaint, is, one, doing full arch dentistry is expensive for patients. What's the average cost of a full arch, single arch, anywhere between 20, 25,000, full mouth, 40, 50,000. How do you make that affordable for patients where you return an affordable loan payment? So it was so simple. And I heard this so many times, is, Dave, make it look like a car payment and not a house payment. And people will say yes. So we studied that, and there's a lot of psychology behind that, but it's very true that if, the monthly payment starts hitting north of $600-700, conversion drops significantly. So that sweet spot, $300 to $600, looks and feels like a car payment, and people get comfortable with that. They believe they can fit that into their budget. They've had car payments, in their, life. They managed it. They didn't lose their car. It worked, paid it off, and then bought another car, but they feel comfortable that nobody's going to take on another mortgage payment because they just, it's just for psychology. You can't, they just can't afford it. It's going to impact their lifestyle. So we had to create affordability. So how do you create affordability in these large case payments? Is you stretch the terms.
Oh, Dave, before we get into that, because these last two are things I want to definitely frame and make sure we take time for the listeners to understand this. Let me kind of mention one thing. I want to go backwards because those last 2 points I want to spend some time with, and I hope you're not in a hurry because I hope we're good on time. Before we get into those last 2 things, here's what I hear from practices. I have XYZ company in my practice. Why do I need another company? Or can one company be? I want to dispel this myth because here's what I believe, and hopefully you agree with it, is you can't have one bank. You can't have one financing partner because financing partners have an area that they work in. Like some people are in that $300 to $3,000 range. Some companies don't even bother to go above $8,000, $9,000, $10,000. Like I want to help people understand why they need to have multiple financing partners.
Sure, there's not one size that fits all. I'm just telling you, that doesn't exist in the marketplace where one lender could be all things to all people. It just doesn't exist. They all, we all play in different, like spaces. So what I usually recommend, practices have multiple lenders. Okay. So if you have an average ticket of $2,500 or less, somebody wants to finance or needs help with crown and bridge or, procedures that are under that, and they still need payment or they need financing. There are lenders that do that. Care Credit is one of them. Okay. They have revolving product.
They're the big one.
That's where they play, right? That's kind of their sweet spot.
They're revolving line of credit. Basically,
yeah, exactly. And we don't play there. So, you need a lender to take care of that when financing is. But once it steps into $2,500 or above, and especially 5, 10, 15,000, other lenders aren't willing to take that risk. They don't want that business. They don't understand that business.
Or they'll approve that. But like you said, they'll approve them for $3,000. It doesn't do any good.
No, exactly. So you need a large case lender. That's kind of what we're known for. But, large case can be anything over $2,500 because, we will approve. And with our underwriting and, our terms and conditions, we will create the lowest payment. That's what patients in general, are looking for. So then, they can manage it. We go up to 144 months, which is 12 years. So I can.
Wait, hold on. Pause. I want everybody to digest that. Okay. Because I didn't know this for the longest time so Dave talked about something that's very important. Okay. It's one thing to get approved and XYZ brand non-specific. XYZ company approves me for a $30,000 loan because I have 800 credit or XYZ, and they give me a payment that's still $1,500. Okay. But they approve me for $40,000, $50,000. That does no good to me as the patient because part of the success of patient financing is how do we put patients in that sweet zone? Let's call it $500. Okay.
Yep.
And any loan is a function of the total dollar amount and the term equals affordability.
Yeah,
and what Dave just
the interest rate.
Interest rate. Yeah, right. Absolutely. Right. So you got the loan, you got the rate, you got the term, and it's all those things. That's what I'm trying to get people to understand that it's all of those things. Okay. And so what Dave just talked about there was one component, the term. Okay. And when you get the bigger cases, I'm going to call from my end, I'm going to call bigger cases $10,000 plus, but obviously you can be a little bit less than that and that's fine. But when you get to these truly bigger cases, $10,000, $15,000 plus, term is so important. And what Dave just said is, and I don't know how you guys do this, but you guys will do loans up to 12 years. So I can take a $50,000 case, okay, and that will bring my monthly payment probably in the $350 ballpark is what I would guess at a 12-year term.
Yeah, it's actually, it depends. I have a couple examples. Like I told you, our average funded loan is around 22.8. If you're looking at some numbers here, and our average approval is 44.8. So let's just stick with those two.
Okay.
The monthly payment on a $22,008 loan, which will get people in for a full arch, a single.
Okay. Yep.
It's about $360.
So I could start. Let me. I'm going to try to give tactical information. I apologize, Dave. So now, what I should do, as an office that wants to do more arches, is I stop trying to play this commodity price game, and I start playing the affordability game. And I stop marketing $18,000 or $20,000. I start marketing. You can get all your teeth replaced with something that stays in your head, starting at $350.
Yeah. Yeah. And we have to help you with the marketing of that because there are disclosures and consumer compliance. I can't let you mislead something that's not
true.
But we would, we'll help our practices. We want to be a consultant and we want to be a partner and help you. So we all do it right. Nobody wants to, have regulators.
So that's what you guys are for. You guys
we'll let us handle that. So just let us help you. But yeah, it would be, like $22,800 loan, payments as low as $360. Now they could be higher based on somebody's credit profile.
Yeah, of course. And if they don't choose to extend it out, and they say, "Hey, I don't want to pay."
Yeah, well, we offer up to 144. So we give patients options from 24 months all the way to 144 months with 12-month increments in between. So if you want a lower interest rate, you're going to go shorter, but you have to be able to afford the payment. So for people shopping for interest rate, we accommodate that. It's just that they have to, be able to pay a higher payment. That's their choice. Yeah. Or if they want the lowest payment, it's a little higher interest rate because I have the risk of the time value of money and the, change of interest rates because these are fixed rate loans. So we have a higher rate, but the lowest payment is the longest term. So, what are you looking for? And the beauty of that, and this is another technique you can have treatment coordinators and we train to is we don't charge prepayment penalties. So if somebody wants to pay off their loan early or make extra payments, absolutely we encourage that. And there's no penalty for that. So it's kind of like the psychology of why do people take the 30-year mortgage and not the 15-year mortgage? 15-year mortgage is cheaper.
Cash flow.
It's cash flow. So they take the lowest payment, which, gives them comfort because they know they can always, make that payment and it's affordable and flexible. But if they have extra money, a bonus came in or something happened where they want to pay down and reduce principal to get the debt paid off quicker, they can do that with no penalty. So they get the best of both worlds. They get, the lowest payment with the ability to prepay if they choose to do so, to reduce the debt quicker, and that gives them total flexibility. So that's what most people are interested in, when they take out these types of loans is the flexibility, and having a lender that doesn't charge prepayment penalties and, could pay off. Patients want to pay it off on their terms, not my terms.
Yeah. And they don't want to feel like I've done loans with these companies before, companies like this, where they say, yeah, we'll give you this. But then what happens is that what they owe, whether they pay it back in 2 months or 24 months, is the whole amount with the interest. The interest is tacked on to the loan amount.
Exactly.
Yeah. Yep.
So they want the best flexibility, and that's what we try to offer. So it's patient friendly. I mean, that's the type of products you want to offer to, have in your practice to offer to patients. So patients feel good about it. And, I always say this, I don't want to, you're changing lives, right? Well, I want to change lives too, but I want to change lives without changing lives. Meaning, I want you to change, I had to get you this life-changing treatment, but I don't want to change your life financially where now you can't afford to do things that otherwise, that you need to do. So, that's the whole theory behind, what we're trying to accomplish. And that's what you want to do too. You do not want to put, and we're regulated, but one of the last things you want to do is put a patient in a loan they can't afford.
Yep.
Because that comes back.
Well, you saw what happened in 2008.
Absolutely. Yeah. It's bad things. And that's our underwriting, has to take that all into account, is that if you can't afford the loan and the loan payment, we're not going to make the loan, because that's the last thing I want, where, you are put into a financial product or a loan where you can't afford the payments. And then all of a sudden, you can't make the payments, but it's impacting, your ability to buy your necessities, medicine, all the things that you need. And it's not, I can't put you under that kind of financial stress. So, it's like I said, we want you to be able to afford this procedure and feel comfortable about it. That's why we make it look like car payments and not house payments. And most people can figure that out.
All right, Dave, the $1 million question, literally. Okay, so great. All right, I get it. Now I get it. I got to have multiple lending partners in my practice. There's a difference in traditional patient financing for what I call drill, fill, bill dentistry. There's a difference in larger dentistry. Okay, now I understand the amount, the term, blah, blah, blah. You said number 7 on your list was quality approvals. All right, so now, great, I got it. How do I get more patients approved? How do I understand the approval process? That's what I'm hearing right now out in the market, is that getting patients approved is a little bit more difficult. So walk through for our listeners, the little bit of the process, what goes into it, and then a little bit about what makes one company be able to approve versus other people. Kind of walk us through that, if you don't mind.
Sure. I'll try to keep it as simple as possible, because it gets...
Please, I'm not that smart.
But yeah, what we're looking for in underwriting are various things. To keep it simple, I'm always looking for, a patient or a borrower's intent to repay. Okay. So what does that mean? How have they handled their credit and debt with other lenders? If their intent is to repay, that
their history,
their credit history, right? So, if your intent is not to repay, that's going to show up. So that's obviously a negative. And I don't want to loan money to people that don't intend to repay me. So we measure that. The second thing we measure is ability to repay. So that's that whole, I can't loan money to people who can't afford loan payments, because that, the regulators came really down hard on that as a result of, like you mentioned, the housing and credit crisis of 08, 09, where they put people in loans they couldn't afford, because what happens, you're going to lose your house, or you're going to do all of the disastrous results of that. So we measure ability to pay. So we have calculations that happen. We ask for people's stated income. We don't verify, but we have ways to pretty much know that their income estimates are accurate. And then we do, with our credit reports, we do what's called a debt to income calculation. So the payment isn't going to exceed a certain percent of their total income, and they don't have, they're not highly leveraged where they can't take on additional debt, all those type of calculations. So assuming that you have the ability to repay this loan. So I look for that. And then the final thing in unsecured lending is the motivation to repay, which is really the hardest one for me, because this is unsecured lending. I'm not going to repo your implants, right?
You can't go, it might cost you more money to go get the teeth out.
Yeah, I can't.
And it's probably illegal.
It's very illegal. So, I always make jokes about that, but no, we don't do that. So what do how do I motivate you to repay? Well, that's where the provider and you come in. It's your relationship with your doctor and the practice that did the work, because you want to maintain, a good relationship if you have issues. So if you're taking good care of the patients, the likelihood, the motivation for them to repay is also there. So we look at all these different things. And then, when I'm making loans over a, 10, 12-year period, I'm also looking for financial stability. So, I'm going to develop a relationship with a borrower for the next 10 or 12 years. What's the likelihood of them, being stable and financially able to repay that loan over that longer period of time? So we look for different things than just credit scores. We actually look at 500 different things, give or take, all instantly. all from databases that we draw upon that we get this data from, and then all of that goes into a complicated underwriting formula, which then decides who's approved for how much and what terms and conditions are offered, and then risk rated for things with interest rates and all the different things that we consider. So I don't want to go any more complicated than that,
Sure.
but we're, that's why you need experienced lenders that knows how to do that. Because I've seen a lot of companies enter this market thinking they can do it, and they don't. They can't, and they come and go. And it's usually because the losses get to be to the point where it puts them out of business, because they're not lending money properly, and they're giving too much credit, or people are going to repay them. So the losses have to be manageable. In my business, I have to price for that risk, and that's what we do. And if that's not all matched up properly, you can lose money in this business. The joke I always tell is, everybody, and you as providers can do this yourself. I mean, T-Bone, you can finance your own patients if you choose to do so. Now, is that
Off in 10 years, I'm not.
Yeah. Well, is that a good idea? No, because you don't know how to underwrite, and and manage receivables and collect and all the things that are part of our business model. You're not be good at. But if you want to try it, you sure can. Some do, but and you can make a small fortune doing it. T-Bone, you're only going to have one problem. You're going to have to start with a large fortune.
Yeah.
That's how you.
Yeah, no, I get it. Yeah.
So all right. So be aware. This, I describe my business model as I make large, instant, unsecured loans to strangers in all 50 states. What could go wrong? So,
well, you say it that way, it sounds a little dumb.
Yeah. Well, if you're willing to take that risk, it's there for you to do, but I would not recommend it.
So I have a couple of questions now. Let's, as we kind of dive into the realities here still, let's talk about credit score. Okay. There's different levels of credit score. There's highly qualified people. And what technically, what is that? 680 plus, 750 plus?
Well, credit scores, everybody thinks they know what their credit score is, right? I mean, that's common. You can find it out. You can, you can actually get it pretty easily. But what most people don't know is there's like 27 different credit scores in the marketplace. So which one is your lender using? Because some of them are designed for mortgages, some for auto, some for credit cards, some for, just different purposes. So they're different. And there are 3 major credit bureaus that do the scoring, and they all do it differently. And, you can have variances, like Equifax, might put somebody at 650, and TransUnion has them at 750. Well, that's a huge variance. So, there's just, it's not perfect. And the credit bureaus totally rely on lenders like me to do self-reporting. So if that doesn't happen, then the system doesn't work. So you got to be a little bit careful, but FICO is the most common, your credit score. FICO is a company that's public that created credit scores, but they generally run from 350 to 850 is the range. Now, why they came up with that, I have no idea, but that's it. So 850 is perfect credit. 350 is the worst. Okay.
Not the least perfect.
Yes. Okay. So you're somewhere in between. And excellent credit is usually 770 and above. I mean, that's outstanding. If you have a 770 and above. Between 700 and 750 is very good, but not excellent. And then you get below 700, 660 to 700 is fair. And then you start going below 660, it gets challenging.
And so that's what we would call the subprime market?
Yeah, subprime's probably below 620. Okay, if you just use the credit score.
So if I have a patient that comes in and says, I have bad credit, does that automatically wipe financing off the table?
Well, you never know. You got to be careful with that one. Here's what I've learned over the years in this business is people who have bad credit know it. It's not a surprise to them, because they've been turned down and told no at uh, other businesses. So, if you're not paying your bills, you're going to have bad credit, or, the things that create, quote, low credit scores are behaviors. So the good news is consumers can improve their credit score relatively easy. They just have to change behavior. The simplest thing is pay your bills on time. Don't take out excessive credit. Don't keep applying for credit. And if you do those things, your credit score will go up, and a lender will take you, once you've demonstrated, some financial responsibility. But it's up to the consumer. I mean, I always tell providers, like, okay, if a patient has poor credit and doesn't get approved, well, that's not anything you did. It's not anything I did. Guess who did it?
The patient, the customer.
So they have that. They may not take the responsibility for it, but they have the responsibility for it, and they can. They need credit repair and create some discipline to work up and improve their credit score. So people will trust them with financial products, right? So,
do you have less than ideal credit products? People for less than?
Yeah, we do. We have a secondary lender.
700.
Yeah, we go down to 660, and then my secondary lender, which is a lender. It's One Main Financial. It's all seamless. It's one application. But if we reject and deny that application for any reason, and the credit score is above 550, then it automatically goes to our secondary. And if they like it, they'll present an offer, and that's what the patient will see. And a quality.
Okay, so that happens. I want to.
Yeah, it's hard.
I want to make sure. So, roughly speaking, if the patient is 660 above, Proceed directly will handle that. Okay,
and they don't automatic. We don't approve them all above 660.
Of course,
denial.
There's debt to income ratio.
The income ratio is not there, or they did something that we're not comfortable with. There are factors that could deny above 660. It doesn't happen a lot, but it can happen. So then we send them all to denials above 550.
The reason I bring this up is having been in the full arch market myself. You bring in a lot of socioeconomic people that need all their teeth taken out and stuff, and they upfront say, "Well, I don't have great credit," and what we have traditionally been led to believe is that we don't have solutions for them. And what I'm hearing is there's a possibility, not a guarantee, but even down to 550 credit score, that they may or may not like the terms, but at least we're giving them an option.
Yeah, you're giving them. And what we find is people that have bad credit, if they get approved, it's a surprise, and it's almost an easy close because somebody's willing to take the risk on them. They say yes, because now I can change my life and do the things I need to do to improve my credit score. With better employment opportunities, all of those types of things. But they're surprised they get yes, and the terms they may not be. They're not going to be the same as somebody that has an 800 plus credit score because it has
risk should they be
priced into it. So, but the good news is it's not forever. And that's how you sell, tell them about it. If they see an interest rate that's like 22%, I'm just telling you that's expensive, but it's not forever. If you do the things that you can do to improve your credit scores and your credit history, you can refinance this at a lower rate with better terms and get out of this. But it's up to you to do that. So you have to do it. But there's hope. You can, this isn't forever.
Yeah.
And it's you're the one that controls that. So yes, you can get a better loan, and the lender doesn't care if they're paid off or not, and refinance this. Another one is our loans are unsecured. So that involves risk because I don't have anything to repo or,
resell.
I have no collateral. So pricing has to be adjusted for that. But people can, take out the loan. And I always recommend, hey, let's make the decision now, go forward. So you get going on. But if you want to refinance this into a secured loan, put up your house, or a car doesn't have any debt against it, go get a car loan or get a loan that's secured. You're going to get probably a lower rate and a better deal. Do that and then pay off payoff proceed, or the lender that's unsecured, and on and on. So they can do that if they want to go through that. It's just that those type of loans are not instant. It takes time, and you have to, get underwritten, and to close those loans just is it's a process and a procedure, because there's appraisals involved. The lender has to do a lot of things to be able to approve and fund those loans. But that's another one. You can always refinance this loan if you're willing to put up collateral, probably with better terms and conditions. I always say our loans are unsecured. So what does that mean to a consumer? We're creating purchasing power, because I'm giving them a credit and they don't have to put up any collateral to obtain that credit. Whereas secured lending is more, you're not increasing their purchase power because they're having to put up an asset as collateral. So it's a net zero sum game. So in general, I'm just telling you, and the providers and the treatment coordinators, if you can help your patients navigate through all of this and get good at it, you're going to close so many more cases, because you start earning trust on behalf of your patient, and they believe you and know that you're trying to help them navigate through this, because they desperately want and need the procedure, and you're the one that's helping them get it. And another fun fact is Goldman Sachs did a survey of just consumers in consumer lending, and they asked some really funny questions. And they wanted to know how well people manage their personal finances and don't talk about their personal finances. So they asked questions like, would you rather change a baby's diaper or talk about your personal finances? And 50% of the people said, I'd rather change the diaper.
Yeah.
For your listening audience, this is another fun one, is would you rather go to the dentist or talk about your personal finances?
Dentist.
When said, I'd rather go to the dentist. So what does that all tell you is, in general, a lot of people's personal finances are messed up, or they don't like, it's just something they don't like to spend time on. They don't understand it. They're not good at it. And they're really, what that's telling you is they're asking for help. And if you can help them through that, and start asking questions on, yeah, you can't afford this payment, and here's why. And if they're trying to manage to a payment, well, what in your life do you have that you don't need? It's amazing how you can find $200, $300, $400 a month out of somebody's expenses that they didn't even know they were spending, and help them to guide it. So, this is life-changing, treatment that you're getting. You don't need 3 subscriptions to, Netflix. Yeah. Those kind of things, where you help them find money. And you get good at it. Another one is there's tax benefits involved in this if you're well trained. And what we try to do is help practices get good at this, and we see a lot of best practices in the marketplace.
Yeah, tell us. Speaking of best practices, talk to. That's kind of where we're at. There is talk to us a little bit about what are the best practices. Like, give us 2 or 3 things that you're seeing consistent in practices that are doing this really well,
that are very successful at doing this. One, you have to get treatment coordinators who are good at this. Do not expect a clinical person who isn't trained in this to get good at this, because they, what they don't know, they're scared of, and they won't close cases. So you got to get somebody that's trained and talented, and your staff that wants to do this and wants to do more of this work, and it's a goal and objective, and you compensate them accordingly.
Yeah.
Okay. So that's extremely important. I would say that you need to know in your practice, a lot of professionals or doctors are, traditionally haven't used financing as a way to generate case revenue. And, they use it as a last resort. So if it comes down to the, money part of it, presenting a treatment plan, and they said, well, how are you planning on paying for this? Well, cash, check, credit card, and then if the patient says, well, I don't have enough cash, I don't have room on my credit cards, I don't have the ability to pay this,
I don't have a check,
and they use it like, well, okay, last resort, let's see if you're eligible for patient financing. and that's not helping your patient, because a lot of patients might be, even if they have the money, this is an amazing fact, especially after the pandemic, is people like to save their cash. They like to have,
I like to hoard cash too.
hoard cash and have that nest egg there for availability. They feel comfortable, they could sleep better at night, all those sort of things. So they have the cash, but they don't really want to spend it. They want to save it. So if you can offer them attractive financing up front and say, hey, it's great, available, see what you're eligible for. And amazingly, if they've got good credit, it's likely they can finance 100% of the procedure without going out of pocket and paying it off on their terms when they want to. Is guess what you just did? You just offered them an option they didn't know they had when they walked into your practice.
Yeah, I call that lead with affordability, and when we're training our customers.
So it's just how you present it.
Yeah.
So
yeah. And so for me, that starts in when we present the case. I don't ever tell a person, hey, Dave, this is going to cost you $50,000 and stop, because you don't have hope there. But for 90% of my patients, you got to say, hey, something like this is typically around $50,000 or a few $100s a month. Okay. Yeah. And then they hear the few $100s a month, they stay engaged. And that's what people got to understand. When you lead with affordability, it starts when you present the fee.
Yep. Well, and the other thing that I find that is the easiest close, I'm told by treatment coordinators, is what I call the sign and drive, where they can commit, schedule surgery, and move forward without having to come up with any money. Because they've been.
Let's talk about that zero down. So you're talking about zero down, correct?
Yep. Yeah. Where
is that pretty common?
When I'm giving those kind of approvals, especially with good credit, absolutely. So, what I recommend is, okay, let's say your treatment plan is $50,000. Okay. And you want to say, hey, did you know that we have great financing with great rates and terms that, you could be eligible to finance all of this if you so choose. Would you like to see if you're qualified for that? And so all of a sudden they go and they apply, and we give them a $50,000 approval. And then all of a sudden an option just, opened up to them that, hey, I don't have to move money around. I don't have to, tap into my kids' college education fund, or I don't have to sell some stocks and bonds in my portfolio, which I was planning on doing, and I can move forward. And then your lender, I could pay this back over up to 12 years, and your lender has no prepayment penalties and allows me to pay this off when I want to. That's an option they didn't know they had. So it's the easiest close, because now you've just eliminated all of the financial hurdles that they had coming in to figure this out, because they weren't ready to write a $50,000 check, even though they had it. You made it now easy.
Yeah, I don't want to write a $50,000 check. I mean, I've got it. Yeah, no, and so here's kind of some of the things I've heard, and we don't have to discuss these, but I'm really talking to the dentists listening now at this point. Dave, are we good on time?
Yeah, I've got a few. I can go for a little longer.
Okay, great. Here's what I'm hearing. I'm talking to the dentist listening, because our listeners have heard me talk about financing for years. It's like at this point, you should know it's important. I hear from treatment coordinators, well, I wouldn't sign up for that interest rate. And what I say is, how dare you judge a patient? You don't know what's going on in their life. You don't know if they're going through a relationship issue because they're not confident. You don't know if they're going through a job issue because they're not confident. You don't know if they're going through a health issue because they can't eat. And so if, I would pay 20% interest if it meant keeping my teeth and my dignity and my confidence. I have issues there with treatment coordinators judging people and making them not present. So number two is, I hear from dentists all the time, well, I don't bring up financing until the patient brings it up. And there's an ego issue for patients. Patients sometimes don't know it exists. They didn't think I could finance my teeth. They don't think about half the battles we get in our own darn way.
Yeah, you do. And like you just mentioned, one of the things, like having them apply early, in the process to see if they're qualified, what they're qualified for. If the decision comes back and they've got great credit and they can finance 100% of it, so they have that sign and drive option if they so choose. So they can put money down, whatever they want to do. You're giving them flexibility they didn't know they had. But what you've also done is you just complimented them.
Yeah.
You have excellent credit. That is just wonderful. And you play to their ego and say, look, boy, you've done it right here. We got this lender's willing to make you this great loan. And you've really managed your finances and your life very well. And you should be proud of that. And, that gives you the opportunity to, really make them feel good because, they have excellent credit and, now that, they know that, and boom, all of a sudden, now you can really give them a lot of flexibility on how to pay for this treatment if they so choose to, want to do that. So it's just, really good techniques.
So you guys have trainers within the organization
we do
that are helping practices?
Yeah. And we have two types of training here. We have what I call level one, which is really when we onboard a new provider, I have to train them on how to use the platform.
Yeah.
All the compliance stuff around consumer lending, disclosure, just the things that they need to know to be able to access the platform and close a loan for a patient. And then what happens if they have trouble? How do you define income when we ask for that on an application? Just all the things they need to know. And then we have a second level of training, which is really getting into best practices for those that want to do that. That's optional. The first training is mandatory because I have to do that. So it's up to, what their goals are. If they want to close more cases and they want to be successful, we share a lot of data with our providers. So I can compare you to your peers and you to our national averages, you to your market, and how are you doing? What type of patient are you attracting into your practice to, qualify for this? So, if you have a practice that is catering to the low end of the credit spectrum, okay, you're not going to get a lot of success with patient financing. So maybe you need to change your marketing, or maybe you need to, do things to attract a higher likelihood of a patient who can afford your treatment, right? So there's all of that. And then you get into like, okay, you submitted this many apps. We approved this many for this, how much, how many of those were you successfully converting? So if I gave you 10 approvals, how many of those turned into a case? And how does that look like compared to what others are doing? And if your conversion rate's poor, then that's an actionable item.
Yeah, well, there's something going on. It tells us, it's interesting. I wrote on my thing, my T-bone tips that I wanted to talk about. And while I've got that up there, so here's what we're teaching. And I look, I'm an open book, so I want everybody to do this, whether you work with us with our business training or not, is here are the three things we track when it comes to third-party finance. One of the three of the things we track. One is how many applications am I doing per month? Okay, like in other words, I have a hard time believing that we put 600 people through our practice every month and we only have 3 people apply for finance. I just have a hard time believing that number, okay, when I talk to practices. How many applications are we? So the first step to becoming successful with third-party financing is how many applications are you doing? And so I set a goal that our practice needs to be doing at least 15 to 20 applications per month in our practice. So that's my directive, my mission to my treatment coordinator is we got to do 15 to 20 applications per month. That's a starting point. The second thing I look at is how many of these applications were approved. And I don't want it to be 100% approved. I think there's a problem in a practice. If you apply for 15 patients and 15 people get approved, that means you're not applying enough. Like you've got to get some denials. Right. Okay. If you're not getting denials, you're prejudging patients somewhere along the way in your process. And then the third thing I look at, what number of these applications are approved and then what number become funded. Okay. Yep. Because if you apply for 20 people, 10 get approved and only 2 get funded, well, then somewhere along the way, you're unselling the case or something's happening. And those are the action items you're talking about.
Yep.
Is you track how many you're doing, you track how many Dave and the other companies approve, and then you track how many people move forward with getting funded. Okay. And that tells a story of where you can improve your practice. Yep. And that to me is super important in the third party financing market. And the fourth number we track is what percentage of my revenue is coming from that. I want the drill fill bill of dentistry to be at 15%. I want practices like mine to be at 30%. That's the level of revenue I want from third party funding.
And that's a great starting point. Is I asked the question of a new client or new practices. When in the onboarding process is, hey, today, what percent of your total practice revenue comes from patient financing? And 9 out of 10 times they can't answer that question because they don't. Okay.
Yeah.
Well, so we go, well, now we got to start tracking that. It needs to be, if you want to do full arch and transform it into an implantology practice,
30-40% easily
expected. And because if it's not there, you're missing the mark.
Yeah.
And then, the other one too, like, another best practice is when you're having somebody apply for financing, I always tell the treatment coordinators to recommend they start with the total treatment cost.
Yeah.
If the patient says, well, okay, the treatment plan is $30,000, I got $10,000 to put down. So, what's a $20,000 loan look like? Well, they can have that option, but then say, well, why don't we apply for 30?
Just apply for all 30. Yeah.
And if you get approved, that gives you more choices.
Yeah. And choices is such an important word there, Dave. Patients want choices because, again, we don't know what's going on in life. Like, people don't know in my life. I got a kid in private school. I got a kid in college, out of state tuition. And yet, while, yes, I have some money, I would like to have choices so that I feel comfortable in decisions. So instead of saying, you know what, let me figure all my things out and let me put this off for 6 months or a year, give them comfort to be able to say yes today. The other thing that you bring up, and we'll end on this one, is I think this is important because what I've seen from my own experience is when you get into big cases, okay, you can't lead with your lowest price and then do the financing. You've got to lead with your MSRP. Discounting is a last resort, and discounting comes after you find out how the patient's going to pay for it. Because here's a reality. Okay, let's just use, I'm selling a case for $50,000. If I know I've got margin in it, I can do that case for $40,000. But let's say the patient works me down to $40,000 or the treatment coordinator $40,000, and then I go do financing and they're less than ideal credit, like whatever profit I have is going to get eaten up in that. So I believe in leading with MSRP, find out how the patient's going to pay for it, and then you have your flexibility in what pricing you can do for patients.
Exactly. No, I agree with that. That's a good point. Yeah, start with your retail price and working down. And with financing, if people are eligible, you don't need a discount.
No, people are looking for a monthly payment, not a price.
Yep. So just be aware of that and become that. But I think just you could be very successful doing this, and I always have told patients, and I show them examples where hey, we want to be your partner and not a vendor. Is kind of a philosophy of mine. But as a partner, I want to help you achieve your objectives. But if you're interested in growth and making more money, I will be a solution for you.
Yeah.
And I've got practices, we'll take on, and the average time I can double the size of their practice with just adding those finance arch cases into their practice, in 18 months or less. And their profitability goes up 3x.
Yeah, it's crazy.
Yep. So, no, we'd love to, have your audience. And I assume, they want to get a hold of me. We'll hit you, like a phone number, email.
Yep. Yeah, it's proceedfinance.com. When you call them, say 3D Dentist or say T-Bone, they'll know where you came from. Selfishly speaking, I do that very, very easily for one reason. One is I want to have some political capital with Dave. So when my customers want special training or they want something or something, they need help, I can go to Dave, like, Dave, can you do me a solid? And when we refer, lots of customers to Dave will do a solid for us. So we're a family, we're a group, and that's what we do. And I vouch for Proceed Finance and Dave personally because they've been instrumental in my practice. They've done an amazing job for our practice, and they are one of the good companies that's been around. I've done other large case companies. I won't use names. They started really strong, and then suddenly some of them took money back from dentists, and some of them have gone out of business. And so we have a honorable, reputable company that you can be confident that when you do business with them, they're going to do good by you, good by your patients, and good for themselves, so they stay in business so they can continue to fund our patients.
Great. Well, I appreciate that. So,
Yeah.
well, thanks for having me on.
Thank you, Dave. Thank you for going long and extending the time. I appreciate it.
Hey, no problem at all. And if you need anything, just you know how to find me, and I'll be happy to help.
Yep. Thank you, Dave. Tell the team I said hello.
Hey, you have a good one. Take care.
You too. Take care.